Well, the U.S. added 175,000 jobs in April. As we've been discussing, that's below what was the expectation, 240,000. There you're seeing it on the screen, as well as some of the other actuals versus the estimates that came in. Let's zero in on wage growth, though. It came in at 3.9% year over year, also below expectations. But how are wages really holding up for the everyday job hunter? Joining us now, we've got Aaron Terrazas, who is the Glassdoor chief economist. Aaron, great to have you on here with us. And I want to get your reaction, first and foremost, to what you're seeing in the wage print part of this employment situation report.
No, thanks for having me. It was a little bit of a relief to see the numbers this morning. For a number of months, it's been safe to take the optimistic side of these bets, perhaps not today. But that wage growth number was a particular source of relief. The reality is there are a lot of different trends happening underneath the surface of it. I like to say we're on a two-track labor market. If you are in the jobs market for high-skilled knowledge workers, it is very much of a buyer's market right now. But if you're in the market for frontline vocational or skilled trades workers, it's still very much of a seller's market.
Yeah, can you elaborate on that a bit more, Aaron, on the latter point that you just made?
Yeah, I mean, you look at the sectors that are still hiring and the sectors that have been really flat over the past year since interest rates have begun to take a hit and companies have changed their hiring postures. There are two very different groups of companies right now. Companies that hire kind of workers with graduate degrees, they have pulled back on hiring, pulled back on wages. Whereas again, for frontline service until perhaps this month, hospitality, leisure, kind of construction, all of those were still going very fast. When you look at the time that workers stay unemployed after a layoff, it has been flat below pre-pandemic levels for workers with less than a college degree. It has been basically flat for workers with exactly a bachelor's degree. It has been skyrocketing for workers with a graduate degree. This is kind of an inverse labor market of most of what we've seen for the past 20 years.
So what does that two-track you just highlighted suggest in terms of the strength of the gains that we saw today?
Kind of the strength of the gains, like the past few months, are still there. They're very real. But we have to keep in mind, for all of the agonizing over soft or hard landing, perhaps the more relevant question is for whom? For whom is this going to be a soft landing? For whom is this going to be a hard landing? And I think there are a number of skilled knowledge workers who are feeling anxious about their jobs, anxious about finding new jobs. And that is an undercurrent that is perhaps washed out in the high-level aggregates.
Where are we at right now in terms of the cycle of people that are upskilling or reskilling, trying to get a head start or a jump start on where the future of jobs are coming in from, especially given the wave of investments we've heard about over the course of this earnings season into generative AI even?
When you look at job postings for generative AI, those are way up. Obviously, companies are looking for this skill set. It is a niche that is growing very quickly. I think for the bulk of workers, though, this is a big challenge. They are having a hard time incorporating these new technologies into their day-to-day skill sets and worry about what it means for them long term. But you're right, that is a source of hiring. There is a lot of investment going into it right now. It is still, I think, very much of a niche.
And Aaron, finally, I guess the question that we've been asking over and over is what this ultimately means for the Fed. A weaker than expected jobs report, certainly taken as a positive in the markets today, but how do you look at it in terms of the timing of where the Fed's likely to cut?
They needed this report after the string of strong GDP prints, after the string of strong inflation prints. This is a data point, particularly that wage data point falling below 4%. This is kind of the data point that they needed to see to really avoid getting very worried, as I imagine they have become over the past 3 to 4 weeks.
Aaron Terrazas, Glassdoor chief economist. Appreciate you joining us today. Thanks so much.
Thank you.